So, good morning, good afternoon, good evening, everyone. Welcome to the first edition of the Mayar Capital Q&A for 2024. We hope you received and enjoyed the quarterly letter that was sent out early last week. And as usual, the format is driven by you, the audience, and we'd love to hear your questions. We've got a few questions here that people have submitted ahead of time. Thank you very much for that. But if you do have any questions that occur to you during the course of the session, please feel free to put them anonymously in the chat and we will do our best to answer them. If you do ask a question you feel that it hasn't been answered, then please feel free to get in touch with us via the normal channels after the call. But let's get straight into it. And we're in January. This is, I guess, an expected question to look forward to 2024, the outlook, particularly with interest rates, global macro, most of which has been driven by inflationary pressures over the last year to 18 months. So it'd be great to hear your thoughts on that.
Very difficult question. Who wants to start? Well, I guess I have to start this one. The truth is, we can make guesses, and our guesses are frankly as good as anyone's about anything macro A and B, especially kind of looking over 12-month period. I think the past 12 months, and I think I started my letter with that, just proves that everyone had macro expectations this time last year. Pretty much everyone was proven wrong. The good thing is that even though we engage in chit-chat about it and can get into heated debate about it, its impact on our actual investment process is de minimis, really. And so we don't have to forecast what's going to happen to the economy over the next 12 months to make intelligent investment decisions about a business that we want to own for multiple years. And it does get easier when you're looking at the economic forecast for a specific business over a longer period of time. And then arguably it does become easier when you're forecasting the economy over a long period of time, because you can ignore some of the seasonality, some of the, even a recession is a blip in the long arc of growth for an economy. And so I don't think I have any special insight about what's going to happen. I can tell you what I think is happening. So it's not necessarily a forecast, but I think rates across most developed economies at least seems to have peaked. This is not a forecast, this is an observation, I think. But that is based on what we think is going on. I think everyone was forecasting a recession last year. I think the number of people who have forecasted a recession over the past 24 months is incredible relative to the fact that 0 recessions have happened so far. So I think that's another surprise. You're going to hear people forecasting a recession now, and even a broken clock is correct twice a day. And so there could be a recession this year, there could be a recession next year, there could be a recession the year after. I know there's going to be another recession at some point in the future. And so we make investment decisions knowing that at some point there's going to be a recession. It's one reason why we don't like to buy heavily levered companies. You want to make sure they survive these little bumps on the road, and they have the balance sheet to even benefit from them by going after markets, acquiring competitors, and so on. So I don't know, Aubrey, do you have any thoughts on that?
I mean, I think, as you say, we've seen the stabilizing rates, stabilizing inflation, and I'm actually quite excited about this because I think this is really, if this continues, and I'm not going to make forecast, but if it does, then this is really beneficial for a lot of the companies in our portfolio, especially the home builders or some of the property-related companies. And, people are talking about 4% inflation like it's really quite high, but this is what we always used to call the Goldilocks sort of number, sort of between 2 and 4%. This is the inflation that greases the economy and that makes things just work better. And if you just think from an average individual, if inflation is at 4% and their salary increases at 4% over 30 years, the value of their mortgage is greatly reduced over a long period of time. and that inflation can feed through into house prices, into more spending for themselves, better consumer spending. And, we will hopefully see this in a lot of the names that we hold in the portfolio.
Yeah, I guess the conclusion is the economy is doing really well, with a couple of exceptions like Germany. I think on the whole things are going well, and certainly a lot better than we expected and what most people expected.
And hopefully we'll feel the effect if it carries on this way. Hopefully we'll see the effect. Now, if it doesn't, because we're not going to forecast the future, if things do take a turn for the worse, then I'm reassured that we have companies that we believe can weather the storms, because historically they have done. And we sort of very focused on risk and what sort of companies will survive that. If things get better, let's say they should do better. But so I'm excited.
So let's drill down for a second into some of the components of that. I mean, most of these questions are driven by inflation and interest rate concerns. They've had impacts on consumers whose spending power is diminished and have to pay more money for their mortgages, can't spend more on stuff. And that's reflected in pessimistic consumer confidence surveys. And yet the consumer spending power seems to have been a little bit more robust than all that combination would suggest. And so what do you attribute that to?
I think a little bit more robust is really underestimating what has happened. I think it's been shockingly more robust and strong. And the consumer has done exceptionally well in terms of spending. Even without the pessimistic supply, the consumer spending in most places around the world has been extremely strong the past 12, 24, 36 months. It's really been incredible. It's most pronounced in the US, of course. And it is most impactful where it makes the biggest 70% of US GDP is consumer spending. I think there are many factors that are impacting that. One factor, and it's different from one country to the other, but one big factor has been that consumers have saved a lot of money during the pandemic through reduced spending and some either tax breaks or government stimulus programs. So savings have been high. Another factor potentially this year has been markets doing well. That has some effect where it feeds into it. But the other thing is that it seems that, and especially if we've reached peak or near peak rates, that there's a delayed effect on consumer spending by virtue of consumers at extreme in the US locking up their mortgages for 30 years. But in most other places in the world, they've locked it up for 3 or 5 or 10 years. And so they're still living in a world where their mortgages are still relatively lower. And if we're going to see rates come down from where we are now, then rates could come down and the whole thing would basically not have registered on the balance sheet of the average consumer. Granted, certain parts of consumer spending has been weaker. There's been two things. One is that people who are on the lower end of the spectrum has suffered more from food inflation, for example. And so you see that where in either countries or income segments where food is a huge part of their basket, they suffered more. But we've seen as pay rises have exceeded inflation in the past 6 to 9 months, we've seen this catch-up effect, and we're seeing that consumer spend again. So that's kind of been surprisingly strong there as well. But you've seen certain kind of categories that have suffered, as you'd expect. So we've seen people spend a lot of money on furnishings, for example, during the pandemic. That sector is still suffering from it. So it's not across the board, even if generally it's done well. There are still these pockets of weakness, but overall, I think it's been surprisingly strong.
I think there's a big analytical trap that is very easy to fall into, which is to look at what's happening just around you and assume that it's happening around the world. And we live in a country here where things are probably worse than they are in most places. But that's because Britain has its own set of economic challenges. And so if you're looking at someone who's had to refinance their mortgage from 2% to 8%, then of course things are going to be really fairly terrible for them. But the UK is just one small pocket of the economy. it's about what 5% of the MSCI World Index.
And it's a small percentage of global GDP.
Yeah, it's it's actually not that relevant in the grander scheme of things, but it has a much greater impact on someone that's based in the UK, or if your news source is the FT or whatever, you're going to take a much slightly warped view of what's happening in the world. So it's important to really try and look beyond your own environment.
And in places like the US, surprisingly, I think it is politically driven, where the political narrative has driven the specialistic view. And you can see it split across kind of political divides as well, where people are spending based on the reality. But if you ask them how they feel, you see it very much seen through a partisan lens. And that's driven by the narrative around how the economy is doing, whether you're a Democrat or Republican as well.
But also, as we were discussing earlier, you were saying that I think the upper quartile income has, people in the upper quartile have not done as well, for their income, whereas people in the lower quartile have. So, even, if I look abroad, I look across the pond, the chances are I'm looking at friends of mine who are in the slightly upper end of things, because that's, well, any of my friends who have moved over there, in order to do that, it almost puts them in that bracket. But that's the wrong thing to do. Let's say that's the analytical trap, to say, oh, well, so-and-so is feeling this, so-and-so is doing this. You've always got to remember that the plural of anecdote is not data.
No, very true, very true. Well, thank you for that. So let's dive a little bit more deeply into the fund, and let's look back this time at performance over the last year. A good year in absolute terms, lagging a little in relative terms, and it'd be great to hear both of your views on what's been driving that and the prospects for performance in the medium term.
So I think you've said it correctly, and I've expressed that in the quarterly letter. I think we've done about 16%, which is a very satisfactory return, especially given the backdrop, both geopolitical and economically, the stuff that we're talking about this time last year. So I'm very happy from an absolute sense about our performance. And it was achieved, I think, by taking a much lower risk than the average market participant. Yes, we have underperformed the MSCI, and the reason we've underperformed the MSCI is very simple. You look at the performance gap, and more than 100% of it is explained by not owning the Magnificent Seven. And again, I wrote about this quarter and last quarter. And it's essentially a question that we have to ask ourselves: are we willing to participate in this party to echo others before you, what we think is irrational exuberance about AI and these stocks getting ahead of themselves? We think it's a very risky game to play. It's not a game we want to play or a game that we will play. We take the money that you've entrusted to us very seriously, and we're not going to take risks that we don't believe we're being compensated for, or risks that we either don't understand or we think we understand and are not willing to take, even if others might be willing to do it. We would much rather take smaller swings at the ball and as they say in baseball, have singles and doubles and not try to go for home runs, and not risk our capital doing it, versus doing something that we think will risk our capital. So that's our view on it. It comes with a cost by avoiding hype every step of the way, and these things do go through cycles. And when things happen like that, the cost is that you don't make 25% in that year, you make 16% is what I did, and we're willing to accept that. Doesn't mean that we're not disappointed, and it's especially disappointing when it happens basically a couple of years too close, and so you end up with a concentration of when this happens. But they do tend to happen in concentrated period, whether it's late 90s, early 2000s. We saw it around 2007, 2000, leading up to 2008. We're seeing it again now, and we've seen it in different countries at different time periods. we would rather stick to our knitting and do what we do, and that's the downside. That being said, when these things do happen, and you do have a concentration of returns in a small number of names in the market, what ends up happening in the periods after that is the market index, just as it was pulled up by these names, the market index gets pulled down by the subsequent underperformance of these names. And we think that in those periods, we think we'll do exceptionally well. We look at our forward-looking returns, and we're looking at extremely attractive double-digit returns for the next 2 years. And we think the market, especially the S&P 500, we think it's going to be very disappointing in the next 3 to 5 years. It's hard to put exact numbers, but I would be surprised if it did better than kind of low single digits the next 3 to 5 years. And I think what we own will do double digits. So I think the next 3 to 5 years are going to be, on a relative basis, one of our best years. That has been the case every time we've gone through a period of underperformance, because these things do tend to correct over time.
Is it ever tempting in these periods of underperformance, even though we accept that they will materialise from time to time, to move into new strategies, use different instrument types in order to bridge that gap in the short term? Maybe, I don't know, derivatives or private market strategies, whatever it may be. Is that an option for you? Is that something that you look at and tempted to employ?
Well, there are two reasons. The short answer is no, and there are two reasons for that. Actually, three. Let Aubrey take the third one. But the first two.
You might tell me what it is.
I think it'll come apparent very quickly, but I'll mention it. You can expand it. But I think the first reason is, by mandate, we're not allowed to do that in the existing fund structure. But then we wrote that mandate, right? And the reason we don't want to do it in our fund is that it's back to the thing I was saying earlier. I am a strong believer that you have to stick to your knitting. You have to do something that you fully understand, where you have a competitive advantage. You can't be good at everything in life. If you're lucky, you can be good in one or two things in life, and accept that there are going to be times where the strategy that you follow is not going to be the one in vogue. And that happens to every single strategy. There are periods where growth has done one well over time, just as value has done over time. But there are periods where growth doesn't do well, and there are periods where fixed income has done better. So in the end, I think you have to stick to something that you understand and be consistent. If you try to switch every now and then, you're going to end up getting yourself into trouble, because you're probably not going to be good at everything that you switch into. And you talked about the narrative of the crow in the letter. And I think it still applies, and I strongly believe in it. In a different structure, and at some point in the future, there might be some similarities between what could be done in private markets and public markets, and we can cross that bridge when we get to it. But in the short term, and I think Aubrey, as head of research, can expand on this, it's a lot more different beyond purely the liquidity issue, the issue of public versus private markets.
Yeah, well, if I look at our research team behind us there, they're not geared up to look at private markets. They're not geared up to look at derivative trades, because these things do require very different skill sets. And so what would be the point in starting a strategy where we can't leverage our existing expertise? Now, if it were someone said, hey, we want a European fund, it's sort of, well, okay, half our time is spent on Europe anyhow, or roughly, or whatever. So that's something that you can actually leverage, our existing assets to achieve. But private markets, they really are so different, and the type of research you have to do is very different. The way you interview management is different. It's so you'd be asking an existing team to do something that they're not going to be the best in the field at. And if you don't think you're going to be have a chance at being the top near the top, is that really something you should be doing? Why not stick to, as you say, stick to your knitting?
Okay, let's talk about that knitting then. You mentioned it a little bit earlier as well. And I think you've written about it a few times as well, namely the optimism about the potential for upside of the portfolio over the next, say, 3 to 5 years. Can you expand on what's really driving that optimism and why you are so confident about that?
So there are two reasons for this optimism. One reason is that we look at the companies that we own and we look at forward-looking returns. We do this every quarter, all the time. We've been sharing it every now and then with investors to show them kind of how we think about things. And it is telling us that what we own and the things in our universe have one of the best forward-looking returns that we've had in a very long time. And you can, if you want to look at it even more simplistically, if you look at the index and take out the Magnificent Seven that I mentioned earlier that have run up, and you look at the rest of the market has not done so well over the next few years. The past few years. Even though, as we talked earlier, the economy is doing very well. So I think there's a disconnect, and the disconnect has resulted in valuations outside these big tech names that are fairly reasonable in absolute terms. And if you actually look at it on an inflation-adjusted basis, because you own real assets that are earning real income in the form of these businesses, markets are a lot cheaper than they were 3, 4, or 5 years ago. And so even with rates higher than they've been, on a kind of forward-looking basis, the forecast for kind of an ex big tech names market, I think, is very attractive. You combine that with our ability, I think, in normalized markets to generate alpha on top of that. And of course, I'm going to be optimistic because I'm seeing really good forward-looking returns.
So funny enough, I was having a conversation with, I won't say who, but they're saying, oh, shouldn't I invest in NVIDIA? And they're doing some really cool stuff. And they're telling me some amazing stuff that they're doing. So one of the things that NVIDIA does, for instance, is it invests a lot in startups. And I think they calculated that for every 100 million they invest in a startup, they get something like $1 billion in sales. But that strikes me as really low quality revenue. In the how many of these startups are going to be around 3 years from now? But that's an aside. I should say that you don't have to be exciting to do really well in the long run. A stock that we've sort of looked at, and I think you owned before I joined, NVR.
Yeah.
Over 30 years, that stock has delivered 61,500%. Now, NVR is incredibly similar to one of the stocks that we own, which we hope is going to follow a similar trajectory over the next 30 years. Hope, I'm not saying forecast, but but NVR, it never grew revenues really above 10%. I think it averaged 7.5% revenue growth over those 30 years. They improved their margin, but not spectacularly. Their returns on capital were really high, though, and they kept redeploying that capital back into share buybacks. 61,500% over 30 years. That's pretty much the same that NVIDIA did, but NVIDIA did it through essentially finding gold. But the point is, you do not need to go for those, super exciting stocks to make super exciting returns. And that's what we're trying to do, and that's what we think we will do. The trouble is, the super exciting stocks, they do it all at once. They discover gold, or whether it's gold or AI or whatever, and they rock it. Whereas, these sort of dull stocks like NVR, or who wants to do that, they only do something like 15, 25% a year. Well, hey, guess what? If you do 15, 25%, well, if you do 25% a year, that is your 61,500% over 30 years. And, sadly, the person who I was talking to said, yeah, no, that's really interesting. That's great. But you know what? I think NVIDIA would be more fun.
Yeah. Well, I mean, that's the other.
Well, if it's not your job, fine. But
I think it's Buffett who said that before. If you want to have fun and do something exciting, take some money and go to the casino. I mean, it's got to be way more fun than buying expensive stocks. And I'm not saying NVIDIA per se is expensive or betting on NVIDIA itself, but I'm saying this type of opportunity, this approach to saying the risk reward doesn't make sense, doesn't tend to work over time. So there is still a chance, a decent chance, that NVIDIA will do well over the next 10 years. I have no idea, over the next 5 years, it might. But on average, if you took that type of kind of investment approach time after time, on average, you'll get disappointed. And it's not something we like to do. Even though we've made mistakes over time, we've generally not had situations where we've lost loads of money. And we like that. We like a low mistake rate in a sense. And when we do make mistakes, we don't want them to be catastrophic. We like that kind of return profile. It's not for everyone. Some people like excitement. We like to sleep better at night.
Okay, well, thanks for that. I think that brings us to the end of the questions. So that just leads me to say thank you very much to everyone who submitted beforehand and during the call as well. Thank you very much as well for your continued attention and support. We really appreciate it. We've said many times that we take the obligation that you've given to us very personally, and we hope these sessions go some way to repay that. And I'll leave it to Aziz to give some closing comments. But until then, we'll see you next time. Goodbye.
Yeah, thank you. Thank you again. I'll echo what Mark said. And we do appreciate you sending us questions even beforehand. I don't know, you might think we're smart or not. Either way, we need time to prepare, especially if it's a hard question. So when you send it early to us, at least it helps us come up with an intelligent answer that would be helpful for both of us. So appreciate you doing that. And until next time, thank you so much.
Thank you.